All right, let's go ahead and get started. Happy Financial Literacy Month. We are so excited that you all are entering today's event called The Future is Now Racing to Retirement. This is the fourth and final webinar that we have for Financial Literacy Month, and we are so excited about this webinar and all of the great tips that you guys will have today. My name is Tiara Bird, and I'm Assistant Director of Career and Personal Development with VCU Office of Alumni Relations. Before I introduce the speaker for today, I would like to go over a few housekeeping points. So this will be recorded. If you joined late, if you missed something, you will have access to this recording later. Also, there is live closed captioning available to access. Locate the live transcript button at the bottom of your screen. Once clicked, select Show Subtitles from the menu. If you're having issues accessing this feature, message our VCU alumni chat bot for assistance throughout the presentation. I would like to thank everyone who submitted questions prior to registering for this event. You guys will be able to ask questions throughout your presentation today. You can use the Q&A feature or you can use the chat. We will try our best to get to all of your questions throughout the webinar. Now, I would like to introduce the speaker for today. Chris Woodbury is the Financial Education Manager for Virginia Credit Union. He has been with Virginia Credit Union for more than 25 years in a variety of roles, including branch manager, loan officer, and quality service manager. Chris is able to offer sound advice and solutions to problems that prepare people for challenges life may bring. Chris's goal is to form relationships with those he serves and provide financial resources and solutions to life's financial hurdles. Currently, he is working with Richmond Public Schools to provide financial literacy classroom lessons to all schools within the city of Richmond. He is also an avid road cyclist, and you can find him riding up to 100 miles weekly on the Capitol Trail. This is amazing, Chris. The floor is yours. Take it away, and we are so excited.
Thank you, Tiara. I appreciate that wonderful introduction. You know, it made me think about, you said I've been with credit union for 25 years. Man, I'm old. Good night. I need this. I need this seminar myself for retirement. So I'm getting close to retirement age. But no, it's great to be with you guys today. And I would tell you this: when I do a presentation, it's not my presentation; it's our presentation. So I want you guys to feel engaged. Feel free to ask questions throughout the presentation. We're going to talk about retirement basics today, things you already probably know, the things we need to go over and put in the front of our minds. So I'm going to share my screen so we can get started, so we can start on time, finish on time. But again, throughout the presentation, if you have a question, a comment, please feel free to share. Let me share my screen so we can get started. We're going to have some fun today and learn some things today, okay? All right, hopefully you can see that. So, you know what? The future is racing toward retirement. And I would tell you this: you think about retirement, we should actually think about retirement as soon as we start working. No question about it. So as soon as we start working, we really should be thinking about retirement. You think about it, if we start working, let's say we start working at 20 and we retire at 65, we got 45 years to accumulate. But you know what? When we're doing that 45-year period, you know what we're doing? We're living life. So a lot of times, because we're living life, things get in the way of our retirement plans. And so a lot of times we put our retirement plans on the back burner. And if you do that, don't feel bad, because it's natural for us to do so. Because you know what? We are an immediate gratification society. So that means we want it right now. So when we think about retirement, that's off in the future. It doesn't fit our immediate plans. So we have to start thinking about retirement in the present. We have to make it immediate. So we're going to talk about that today. And so when we think about it again, we talk about the basics of retirement. If you have any questions, any comments, feel free to interrupt. Let's get to the first screen here. So here's our retirement questions. Here's some basic retirement questions that apply to everyone on this call, including myself. Here's the first one. What does retirement mean to you? Now, retirement may mean, we think about retirement, most people think that means I'm gonna stop working. But what does it mean for your lifestyle? So whether it's like you want to take up a hobby, or you just want to chill out for the remainder of your years, or you want to travel, or you like me, my goal when I retire, I want to move to Arizona. I'm trying to convince my wife I want to move to Arizona, and I want to cycle every day. I want to cycle the state of Arizona. Then I'm gonna try some other areas as well. But I don't want to ride my bicycle during my retirement. So what does retirement mean to you? Then when do you plan to retire? Some people, hey, I'm gonna work 45 years, or how long I have left to 65 to manage your retirement age. Or I may work longer than 65, or I may want to retire early. Again, what does retirement mean to you? When do you plan to retire? And these are all key components of our plans, because this is going to determine how much money we need, how long we're going to retire, and what can we do to start planning for it. Then next but not last, how long will your retirement last? So these are three key questions that we should all ask ourselves when we think about retirement. They're the basic questions we need to answer before we even start going forward with our retirement plans. Okay. So we got those out the way. Let's go to the next one. Let's think about early retirement considerations, because I wish I could have thought about this early when I was a young person, when I first finished college. I wish I would have thought about, hey, you know what? Let's start planning for retirement. But instead of planning for retirement, I just started thinking about life, getting married, having kids, buying a house, buying a car, accumulating things. So I didn't think about early retirement. But here's some early retirement considerations. Let's look at this first one. If you retire early, the only thing that's a drawback to early retirement considerations is fewer accumulation years. So if we retire early, less years to build up that retirement nest egg. So that's one thing we have to take in consideration. So if we are thinking about retiring earlier, that means we're gonna have to earmark more money toward retirement. So again, we have to think about those fewer years to accumulate. If we retire early, a long distribution period. So say we think about retiring at 45, wouldn't it be great? Man, and we live another 50 years to we're 95. That means we have to have enough money saved away for that retirement for 55 years of living. Now, that's the extreme. Most people are not going to retire at 45. But if we could retire at 45, wouldn't that be great? Or even at 40, or even at 50, that would be great. But if we want to do that, if that's our goal, early retirement, we have to figure out how we can get there. And that's going to mean sacrificing now to get to that early retirement date, okay? What about impact on our Social Security? And we always tell people, speak to a Social Security expert, speak to your financial advisor. When we think about anything that has to do with your Social Security or your pension, we want to make sure we're having that conversation with the people who can advise us the right way. And then medical care as well. If we retire early, will we have to pay for a medical program ourselves? Or can we somehow still stay with our employee, but we're retired, the connection's not there, how are we going to pay for our medical care? So these are all things that we can consider when it comes to early retirement. Then finally, the impact on our pension plan. If we start taking money out early, do we have enough to cover that early retirement period? So how long if we're going to have to draw on these funds, do we have enough money to last? Again, these all things we have to consider when we're thinking about retirement. And, it's one of those things where people are like, oh, Chris, I don't feel like I'm talking about this right now. But you know what? It's your life. What do your lifestyle looks like for you, and where you want to go? And so these are all decisions we have to make when we start thinking about retirement in our current life, where we are right now. Look at the next one. What about delayed retirement considerations or working after retirement? And I always like this because you know what? We can retire or we can delay retire. And so for one thing that impacts us, if we put off the retirement, we have more years to accumulate. So even we feel right now we're behind, we're in good health, we like our job, why not put off retirement? Maybe go past 65. Maybe we go to 68. Maybe we go to 70. We like a job that we really enjoy. Why not keep working until we're 75? I mean, again, it's up to us, and we have to determine what our lifestyle is going to be. But here's the thing, if we're enjoying ourselves, we're in good health, why retire? Again, it's up to us and what retirement looks like. That first screen we looked at, that first slide, it said, what does retirement look like to us? So only we can determine that. But if we decide to put off the retirement, that's not a bad thing. That could be a good thing for us. One thing's benefits, the more accumulation years. We look at the shorter distribution period. So the longer we work, the less time we're going to have for that distribution period. So again, impacts our well, but it helps us if we're accumulating a lot and we have a short distribution period, we'll have more than enough money to take care of our needs during our retirement. Then look at the impact on our Social Security. Again, the longer we work, the less time we're picking for our Social Security. So our Social Security still be there. We have that money to assist with our savings as well as our pension fund. So again, shorter distribution period, more income during our retirement. Then the impact on our healthcare. If we're working, especially if we're continuing to work, the majority of our healthcare is coming from our employer. So if that's still being taken care of by our employer, we're contributing to that. That's less cost for our healthcare. So those are some of the impacts, some of the benefits of working longer. And here, even if we retire and say we retire, but we still want to get a part-time job. Some of the benefits from working a part-time job, we decide to work after retirement. We can earn some money, and the money that we're earning is going to reduce the demands on our personal savings and from our retirement amount. So that from our retirement account, so that helps us. Potential access to healthcare. So if we decide to work after retirement or work part-time, maybe we can get some healthcare coverage from that employer. Again, a benefit from us that it takes lessens our cost for us when it comes to our healthcare. And then we can have those non-financial benefits. Maybe that company has paid vacation bonuses that we can use as well. So there are a lot of things. I always tell people I'm the type of person where if I can work longer, I want to work longer. And so even though I'm looking forward to retirement for me is a little while off. Now I may change my job. I may take a different job and go do something else. But again, if it's something I enjoy, and I always tell people this, if you enjoy your job, does it really feel like you're coming to work when you're coming to work? Like right now, I would tell people, I love the job I do. I love financial education. I love going into the school systems. I love dealing with people. So when I come to work, it's really not a job for me. I mean, I'm glad I'm getting paid. I hope the Virginia Credit Union is not looking at this and they'll continue to pay me. But I love doing what I'm doing. So it's really a love and a win-win situation for me. And so that's what we want to shoot for when we think about retirement. Even if we're going to put off retirement and we say, hey, you want to continue to work, let's make sure we're in a career that we enjoy going to work, and we can still get those benefits from being employed. Now, when we think about how long will retirement last, I would tell you this: with the advances in healthcare and just regular personal care, we're taking better care of ourselves. We are living longer. We're absolutely living longer than the previous decades before us. And so when we look at it, the estimated time we're living right now, if you're 65 years old when you retire, you expect to live at least 19 to 20 years longer. So we're living till we're 85 and longer. And so when we think about that, so we have to make sure if we're retiring at 65, we have to have enough money, at least enough money to cover our expenses for the next 20 years after that 65 age period. So again, the thing is with the advances that we're seeing, the average life expectancy, it's going to grow. So we're saying 20 years now, probably another 10 years, that might be 25 to 30 years that we're living long. So we're going to see people living into their 90s regularly, 95, 100 years old. Do we have enough money if we're retiring at 65 to take care of that extra period of time that we're living? So that's one of the things we want to think about. One of the things we have to contemplate. We have a class that we call the psychology of spending, or the why behind buying, right? When we look at this class, we think about the things that drive our spending decisions. We did a study, and 95% of our spending decisions are driven by emotion. So when we think about that, and we think about the things that we want to buy, things we want, and things we need, but if 95% of our spending decisions are driven by emotion, one of the things we have to focus on is taking our emotions out the equation and putting our heart into the equation. And I'll tell you why I say that, because for me, I have three older, my kids are grown now. And so for me and my wife, as we go older, one of the things that we focused on, we made sure that we're taking care of retirement, because we don't want to be a burden on our kids as we get older. So as we get older and our health starts to wane at some point, we want to make sure that we have enough money set aside that whatever that needs to be done for us, our kids won't have to come out of their pocket to take care of that. And so that's, for me, I always think of it. My wife said that, it's a loving gesture by us, but it's something I feel like that we should do. And so when we think about our family, the impact that our retirement, or as we get older, we're having on our family, think about things we need to put in place now so we can have those things in place so they won't impact our families in a negative way. So again, those are some of the things we think about. We think about life expectancy, how long we're going to live, the impact on our finances. We just have to make sure it makes sense for us, it makes sense for our lifestyle, and that we can afford it. Okay. And, when we think about retirement lasting longer than 25 years, I would love to live to like 150 years old. I want to be able to still ride my bicycle if I'm 150 years old. But again, though, we want to make sure we have enough money to cover that. Okay. Let's look at this next slide. So retirement income planning, our goals. Here what our goals look like. Here's some things we should look at. And there's three things that we should look at when it comes to our retirement income planning. Here are the major three things we should look at. First thing we should look at is we need to maximize our ability to enjoy our retirement. So Again, we look at that first screen, we talk about what does retirement look like for us. When you think about retirement, what do you want to do? What type of lifestyle do you want to have? Where do you want to live? You want to maximize your ability to enjoy your retirement years. So what does that look like for you? Does that look like living near the beach, in the mountains? If you want to travel, you want to be close to your family. If you have kids and grandkids, you want to be close to your grandkids. What does your retirement look like? And how can you maximize your ability to enjoy that retirement? That's one thing, that's the first thing we want to think about. And if we think about that, we want to manage the risk of outliving our income. So we want to manage that risk. And so when we think about managing that risk of outliving our income, we always think about, people always say, well, Chris, you know what? I need to save X amount of dollars. I need to have X amount of dollars put away. And they say, Chris, what is the X amount? What's the amount I need? I said, well, that's hard for me to say because you have to determine what your lifestyle is going to be. But I can tell you one thing, and we're going to talk about this later on in the session, and I'm going to get a little ahead of myself. One of the best ways that we can manage the risk of outliving our income is making sure we manage our debt and the amount of debt we accumulate in our lives. And I will tell you this, for everyone on this call, I want you guys, if you don't take anything from this session, I want you to take this from the session. We're not designed to carry debt our entire life. And that may be strange coming for a guy whose business is to loan people money, but we're not designed to carry debt our entire life. At some point when we're working, so from 20, let's say from 20 all the way to 55, right? We're in accumulation mode. You know, we're starting our careers, we're starting our families, we're buying cars, we're buying homes, we're putting kids through school, we're putting ourselves through school. We're living life, right? So it makes sense for us to accumulate debt during that period of time. But at some point in our lifetime, we get to, let's say 45, 50. You know what we can see? We can see on the horizon, we can see retirement. And if we can see retirement, that means during at retirement, our income is going to come down. Our debt should always be lower than our income. And so for us, at some point, we have to stop accumulating debt and we have to start reducing debt. And I always tell people, the sooner the better. And I'm not saying that we can't use debt because you use credit or get in debt, because we need it. None of us are walking around with 25, 30, 40, $50,000 to buy a car with cash or pay for a home with cash. Okay, I realize we have to get in debt, but we have to look at the amount of debt that we get into, whether it's credit cards or other things that we buy, are they necessities? So again, for us, managing that risk of outliving our income is totally related to how we manage our debt today and how we're going to manage our debt into the future. If you want to give you a raise, I can get everybody on this call a raise right now. You don't have to go to your employer to get this raise. Reduce your debt. The money that you're paying people outside, you're paying creditors, pay that to yourself and put that back into your income, into your budget. So again, if we can reduce that debt, that's one of the key ways we can manage the risk of outliving our income. Then the third component of this is managing the risk of unexpected life events. And I will tell you this, we all are going to live, all going to have some things going to have unexpected to us. None of us going to live a perfect life. So we have to plan for it. You know, we do a class called Planning Savings for the Unexpected. And we always ask people, do you have an emergency savings account in place? And I would tell you, the majority of people do not. The majority of people have what they call their emergency credit card. We're going to talk about it as well. Instead of relying on the emergency credit card, if we use that emergency credit card, we actually creating more debt. We should have an emergency savings account set aside. And that emergency savings account helps us reduce our debts, minimize our debts, and that helps us to save. So again, we're going to talk about the impact of that as well. So again, the three things we have to think about is maximizing our ability to enjoy our retirement, managing the risk of outliving our income, and then manage the risk of unexpected life events. And those things aren't going to happen, but we can plan for them, okay? Let's look at this one. So here's the retirement income planning process. Here's the process in a nutshell. And again, this stuff that we all know, but we have reminders. And so here's the first part of the process. Let's look at this. So first part is estimate how much we're going to need for our income, how much we're going to need during retirement. But again, though, you can go and talk to an expert. You can talk to a financial advisor. And they're going to ask you the same question that I'm going to ask you. What is your lifestyle going to look like? What do you want your lifestyle to look like? And so you have to figure out what I want my lifestyle to look like. And that lifestyle that I have a picture for myself, how much that's going to cost. how much that's going to cost. Okay. Now, if we do that, we're going to consider any major factors, whether it's, inflation, healthcare, the cost of where I want to live, the state where I want to live, what are the costs there that's associated with living in that area. We have to estimate all those things and put those things in our calculator and try to figure out what that cost is going to be. Because you know what? Living here, let's say, for example, living in Virginia right now, I live in Glen Allen, Virginia. It's going to be more expensive for me to move to Arizona to live in Scottsdale, Arizona, than it's currently living here in Virginia. So I have to ask myself, okay, maybe my retirement plans are I want to live in Arizona. Do I have enough money accumulated for me to move to Arizona? And so those are some of the things we have to consider, what our cost is actually going to be. Then we can look at the total income. What's our income can be for our retirement? So do we have a pension plan? Do we have a savings plan? Do we have an IRA that we set aside? Do we have Social Security coming in? What's going to be our income streams? And figure out what those income streams are going to be and what that amount is going to be. And with that amount of money coming in, can we afford the lifestyle that we have pictured for ourselves? And here's where a lot of people have some issues when it comes to their income streams and the lifestyle they have pictured. Well, for me, I always think about this, and I tell my wife this. So when we get older, in my mind, our lifestyle should be simplified. So if you got a bigger house, I want to downsize to get a smaller house. If I'm not going to work, so I don't have to have a big car, or my kids are out of the house, I want a smaller car, maybe an electric car. I'm trying to figure out how can I downsize and minimize to meet my current lifestyle. So if I don't have 3 kids and I don't have to have the dog and I don't have to have the big SUV, well, that's something I may want to consider downside. So where you are in your life, do I have enough income to afford my lifestyle? And your lifestyle that you currently have, we're not going to project that forward to our retirement because our lifestyle, our circumstances are going to change. Now, I'm not saying if you enjoy traveling right now that you can't travel. Absolutely, travel. If that's your goal for your lifestyle, travel. One thing I'm saying, estimate how much it's going to cost, and based on your income, can you afford that projected lifestyle that you want to have? And so those questions we got to have we have to have those conversations with ourselves, with our spouses, with our family. Then we talk to our financial advisor. Financial advisor is not going to be able to answer those questions for you. They're going to give you some direction, some advice, make some suggestions for you. But those decisions we have to come to. We have to come to a decision. Okay, here's what I can afford. Here's what I want, but here's what I really can afford. And so we find that area we can compromise. We can't get all the things we want, but we can get close to it if we plan for it and start planning now. And if we feel like we're behind, say we've been working already a little while, it's still time to catch up. We make those adjustments. We put more money away towards retirement. We start spending less money now. We start decreasing our debt now. There's still time to catch up. So again, those things that we need to consider. Next component is identify the gap. So here's where I want to be. Here's where my income is. What can I do to bridge that gap? What can I do to bridge that gap? And so sometimes we have to bridge that gap by, if we can't bring our income up, we might have to lower our expectations of what our lifestyle is going to be in retirement. But now if we can bridge that gap with some funds, that's okay too. But again, though, once we identify where that gap is, that's we start trying to figure out how we can bridge that gap. And a lot of times we use savings to bridge that gap. But again, that's what we start thinking about, how we can bridge that gap. Okay. Again, all these things, when we think about the process, this is the process in a nutshell. And again, we are aware of this process. We just have to make sure that we stay focused on that process. Okay. Let's go to the next one. So the future is now. Where do I start? And so let's see where we start. Oh, excuse me, one time we got to interrupt where somebody had to come and get somebody's office because I'm using somebody else's office because I'm doing about 100 presentations a day and I'm all on the road, and I apologize. And the young lady said she's sorry, but she's not sorry. She wanted to come and interrupt.
It's totally fine.
Totally
fine.
That's my wardrobe assistant. No, let me stop.
Thank you.
Thank you. And so, one thing, it starts with a mindset, and we have to change our mindset. And I will tell you why I say that, because one thing we look at right now, again, we're a immediate gratification society. I can't say it. We're a immediate gratification society. And so we think of the present, right? We have to start changing that mindset. And one of the things we have to make a priority, we have to make ourselves a priority. And so when we start changing that mindset, we have to make saving for retirement a priority. And so I look back and I say, I wish at 22, 23, 24 years old, when I was finished college, starting my career, I wish I would take retirement more seriously. Because at that time I was like, man, I'm not thinking about retirement. I'm thinking about, man, I'm a young branch manager. I didn't know what I was doing, but I was a young branch manager. I'm like, I'm going to buy me a car. Next thing I know, I'm getting married. I'm looking for a house. I wasn't even thinking about retirement. I was thinking about it now. But I wish I would start putting money away earlier. But again, we have to have that paradigm shift and make sure that we're thinking about retirement now. And then once we do that, we have to make the decision to save. Because, a lot of us say, I'm going to start saving, and I may start saving next week. No, I'm going to start saving. Once I pay this bill off, I'm going to start saving. Oh, you know what? I'm not going to start saving now. I'm going to wait till the beginning of the year and I'm going to start saving. That's going to be my New Year's resolution. I'm going to start saving. And you know what? We never start saving. So we cannot put it off. We have to start saving now. So we make that a priority for us. We start saving now. We act on it. And then once we act on it, we invest in our future self. Again, we have to get away. I know we have to focus on the present because we have to take care of things in present, but we have to think about, more likely, we're going to live for a long time. And so we have to think about our future self and what can I do now to invest in my future self? And we can put money aside right now. We think about the money we waste. We can put money aside right now to invest in our future self. But again, we have to make it a priority. We have to make sure we start doing it now. Okay. So let's look at some things that impact us right now that sometimes that can prevent us from saving. So let's take a look at this first thing. So one of the things that sometimes we fail to do, we fail to put a spending plan in place. And the only thing a spending plan is a budget. And sometimes, you know what? We fail to put a budget in place. And I will tell you this, if you put a budget in place, it will help you control your money. It will help you achieve your financial goals. You absolutely have to do it. Another one of your homework assignments, if you don't have a budget in place that you regularly follow, and I'm not talking about the budget that you keep up here in your mind and say, you know what, I know how much money my bills, I know what my bills are. I pay that and whatever's left over, I'm gonna do whatever's left over. No, I'm talking about a budget that either you electronically have or you have it on a spreadsheet or you might write it down. I don't care how you do it, but a budget that you have with your income coming in, your expenses going out, what those things are each month. You've already figured out what your gas is, your utilities, your food, everything. You have it on a sheet and you follow this month in, month out, year in, year out. It will help you achieve your financial goals. It'll help you recognize where your gaps are, where your spending is, where you overspend. If you have a budget and a spending plan in place, I would tell you it will absolutely help you achieve your financial goals. And I would tell you this, one of the things we look at when it talks about a budget, and one of the things a lot of people feel like a budget is restrictive, is not going to let them have fun. But I'll tell you, it actually absolutely have the absolute opposite effect. And so if you have a budget in place, it absolutely gives you control of your money. So now if you want to budget for, say you have a hobby that you like, you enjoy each month, put that in your budget. If you want to budget for traveling, put that in your budget. It gives you control of your money. We want to have control of our money instead of our money having control over us. So again, the first thing that help us toward our retirement goal is having a budget in place, taking care of our day-to-day, our month-to-month, our year-to-year expenses, and having a plan for those. It helps us achieve our financial goals, okay? Next thing we want to look at is having an emergency savings account in place. Now, I cannot tell you, how important it is to have an emergency savings account in place. Most experts tell you to have anywhere from 3 to 6 months worth of living expense saved up. I would tell you, if you can start with $500, you get $500 saved up, and then move toward having 1 month's worth of living expense saved up. It absolutely helps us. And so, again, I mentioned earlier, none of us going to live a perfect life. Unexpected things are going to happen to us. Unexpected expenses are going to come up. We need to have an emergency savings account in place so we're not juggling bills to pay this expense, or worse yet, we're not going into debt, borrowing money, or putting on a credit card. And I always tell people, I try to explain this way and kind of illustrate it this way. If I was to leave out here right after we finish this webinar, I leave out of here and I get in my car and I drive down the street and I'm heading back to my office. I run over a pothole and I blow my tire out and damage my rim. Well, you know what? I don't have an emergency savings account. I don't have any money saved up. So to get my car repaired, what I do, I just put it on my emergency credit card. I put on my emergency credit card, and the cost for that all today was $1,000 I put on my credit card. Well, you know what? At the end of the month, I'm not gonna pay that $1,000 off. I'm just gonna pay the minimum balance off. I'm just gonna pay the minimum balance off until I can get that $1,000 paid off. But by the time I pay that minimum balance, that $1,000 expense now is probably $1,200 to $1,300. I'm paid $300 or $400 um in interest. And so now not only that emergency cost me more money because I didn't have any money saved up, but also I extended the emergency because now I'm paying, instead of that one time taking out of my emergency savings account, I'm paying a monthly installment payment on a credit card because of an emergency. So, when you say I got an emergency credit card, okay, in theory, it sounds good. But in reality, unless we're going to pay that off at the end of the month each time and pay the total amount off, it's costing us more money to put that on that emergency credit card. So we say establish an emergency savings account. And here's the thing, and one warning about emergency savings account, and I'm going to show you this. So if you create an emergency savings account, I cannot tell you what constitutes an emergency for you. But I will tell you this, if you set up an emergency savings account, you have to make a list of 5 to 10 things. Your list may be longer or shorter, 5 to 10 things that constitute an emergency for you. And if something happens and it does not show on your list, you cannot go into that savings account and pull money out. Because if we set up that emergency savings account and we just arbitrarily pull money out, it's no longer an emergency savings account, and we'll pull that money out until there's no money left in the account. So we have to in our mind say, hey, you know what? This account is earmarked for this type of emergency, or if this event happens, that's where I'm gonna pull this money from. If this event if something happens, doesn't show up on my list that constitutes an emergency, I'm not going into that emergency savings account. And now I would tell you, does it take discipline? It absolutely does, because as you see that emergency account start to accumulate and accumulate and it's growing, you say, man, I can take that money and move it somewhere else. Well, if that's the case, set a goal for you in your emergency savings account that you have an amount that you want to reach. Well, I'm gonna have at least $2,000 set aside for my emergency. Okay. If your emergency account gets beyond $2,000, you take that excess beyond 2,000 and you earmark it somewhere else, like paying off a debt or establishing another savings account. But the idea of the emergency savings account, it absolutely helps us save money, because when we don't have money set aside for the unexpected, it costs us extra money in the long run. So again, and that undermines our financial health, undermines our financial goals. And if our goal is to start planning for the future, and our future says, you know what, down the road, we're trying to save now for our retirement and all the future expenses. If we don't have an emergency savings account in place, that's going to undermine those goals. So we want to make sure that we have that in place, okay? Let's look at this next one. Debt repayment. So we had talked about this earlier, and we'll stay here for a few minutes. Again, if anybody have any questions or comments, feel free to do so. When we think about debt repayment, this is one of my things. And my wife and I always get into a conversation about this. And so for me, I do not like being in debt at all. The only debt I want to have is my mortgage. And of course, you're going to have your utilities and your food and health and transportation back and forth. But other than that, I don't want to have any more debt. I don't want to owe anyone. And I always tell people this, when we think about debt, again, we have to accumulate debt because we are not walking around with thousands of dollars in our pocket or in our savings account. That should be our goal, but we're not. But until we get there, do we have to use credit? We absolutely do. But we have to use credit responsibly. And so when I say that, we use credit for a specific reason, for a specific period of time. So if I'm buying a car, it's a 5-year note. Okay, at the end of that 5-year period, that car is paid for. I will ask you this. If I buy a car and my note is a standard 5-year note and I finish paying for that car, will my car continue to work after that 5-year period? Well, a car lasts longer than 5 years. If we do the normal maintenance on and take care of that car, will it last longer than 5 years? And the answer to that question, it absolutely will. But then here's another question for you. If that's the case, and we know it's going to last longer than 5 years, how on average in the United States right now, on average in our lifetime, we're going to buy 10 cars in our lifetime. And on average, we're going to finance 6 of those. So that means we're going to go into a contract. And most car contracts, when you finance your car, it's usually a 5-year deal. And so you can pay that for 60 months or 5 years, right? We'll go into that on average 6 times in our lifetime. So from the time we're 20 until we retire, maybe a lot longer, we're going to finance at least 6 cars. My suggestion is this. If a car is going to last longer than 5 years, when we finish paying that car note, and right now, if you have a car note, when you finish paying your car note, act like you're still paying it. And instead of paying that car dealer or that lender, instead of paying them that car note, pay yourself an accumulated savings account. Because you know what? The average car in the United States right now is anywhere from $25,000 to $30,000. We buy that new, right? If we finance that for 5 years, we're gonna pay anywhere from, depending on the interest, we're gonna pay anywhere from $27,000 to $33,000 for that total loan. How many of us on this call right now couldn't benefit from having $28,000 to $33,000 in a savings account? And we can do that in a 4 or 5 year period if we act like take that same car note that we're paying right now once it's done and continue paying it to ourselves and accumulate that in a savings account. And we have to change the mindset, that paradigm shift again. We have to change that. Instead of paying someone else, we need to pay ourselves. So we can accumulate this money if we just have that paradigm shift. So one of the things we want to stop doing is paying debt. So we're gonna, it saves money on interest and fees, helps us maintain our credit. And I would tell you, eliminating debt absolutely builds our net worth. And so again, one of the things I want you to take from this session today is one of my goals. If my goal is to try to start planning for retirement, I have to think now in the present. But one of the things that undermine my financial health as well as my retirement plan is a lot of debt. So again, I know we need the basics. I know we need homes, cars, transportation, food. I know we need those things, but it's the extra stuff. Let's take a look at those and see how we can reduce that debt. And then if we get a car, every time a new model year comes around, do we have to get that new model year car? So can we, keep our cars longer, take care of them and not accumulate as much debt? So again, so those are some of the things that can help us when it comes to our retirement plan and our overall financial health, okay? So that's another thing we're taking a look at. Let's look at this next one. And what about retirement? So let's come to retirement. Can we think about that? So we think about retirement again, saving now for retirement. We absolutely can do it. It can help us when we think about our standard of living. And, again, for me, when I think about my standard of living and when I think about retirement, I know when I retire, my life is going to change a little bit. Again, I want my life to change. I want to simplify, but we don't want to simplify. We can start saving. We want to keep our current lifestyle when we retire. We can do that as well. But again, those are some basic things we have to do. We start early, regularly saving. We think about regularly saving. And again, here's a question for us to think about. If I'm not saving right now, what's keeping me from saving? And if it's the fact that, I can't, make myself do it, or I'm not, consistent enough to do it myself, can I automate it? Can I have it automatically come out? I would tell you this right now. I can't, if I had to save myself and every day go and put money in that account, or every time I got paid, go and put money in my savings account, it would never happen. So me having to automatically coming out of my paycheck and automatically going to my savings account, that's the only way I can do it. So can we automate it? And then are we taking advantage of our company sponsored programs? Do we have 401ks at our company programs? Do we have government backed programs with our company? Do we have pension plans with our company? If we have any company sponsored programs as far as retirement is concerned, that's going to contribute as well as, or match our contributions, or give us some of that additional money that's free, we need to take advantage of. We need to take advantage of, because a lot of times when you got company sponsored programs, you're not going to get a better return anywhere else out here in the market other than from your company sponsored program. So if you're not taking advantage of that, take advantage of that. And then you have to think about savings. And again, here's a hard part for us now, the society that we are. If you're thinking about savings, we have to think about it in the long haul. It's for our future. We're investing in our future self. And it's hard, but again, because we're an immediate gratification society, we want it right now. So we have to think about it in the long haul. But while we're doing this process, we still can enjoy life now. We just have to make sure in our budget and our plans, it makes sense, the amount of money that we're allocating for our current lifestyle, as well as the money we're putting away for our future self. So again, can we do it? We absolutely can. But we have to plan for it. It's not just going to happen. We just can't take a haphazard approach to it. We have to have a plan for it. We have to sit down. We have a significant other and we have family members that live in our household. We have to have a family conversation. Hey, you know what? Here's what our financial plan looks like for this year. Here's what it looks like for the next 5 years. Here's what it's gonna look like projected down the road for the next 10 to 15 years. Here are our financial goals for our family. So if you have kids, you know what, we want you to go to school. Here's our plans for your tuition or what have you. We're planning for that. Here's our plan for mom and dad's vacation plans, our family vacation plans. We're planning for that. Here's our plans for our future down the road. We're planning for our retirement as well. These are conversations we have to have in a family setting. Unfortunately for a lot of us that we don't have those conversations because sometimes we feel like they're difficult conversations, but you'll be surprised. Our young people are so smart today. They are very aware of everything that we think they're not aware of. They absolutely know. And so having a conversation with them and just bringing them in the conversation absolutely helps them understand, but also absolutely prepares them for the future as well. Because at some point, they're going to be facing the same decisions that we're facing today. So again, those are some of the things we have to think about. And can we start now? We absolutely can start now. And that's the goal we want to have. So when we think about it, here's some things we're going to recap and reconsider. And then after that, we're going to open up to any questions you have. But things, we think about, when do I want to retire? How long, I should plan for what that period is going to be like. What my income is going to be like. Do I have enough income to sustain my retirement? What's the impact going to be on my Social Security and my employee pension fund? Those are all things that you talk to your financial planner or your HR person with. Those are the conversations you have. Those are the conversations we can have now, because once you have those conversations, then you can determine your plan. Then once you determine that plan, you put it into action. Now it seems like a lot, right? But it's really not. It's really not. When we think about it, okay, again, what do I want my lifestyle to be? Where I want to live? What are my expectations right now? What are my goals for the future? When we start visualizing those, putting that plan together, you'll see that once we get the plan together, throughout our life, what we're going to do, we're just going to adjust the plan because things are going to change. You may want to live on the East Coast right now, and then know what? A couple of years later, well, I want to move to the West Coast. So you adjust, look at the cost, so we adjust. But again, though, it's a living, breathing thing. And it's a thing that when we think about planning for our retirement, it's something we should start doing once we start working, but we don't think about that. But as soon as we can start thinking about it and putting that plan in action, I would tell you what, it'll give us a sense of security. We'll have a plan for our future. And it's something we can look forward, not with dread, but we can look forward to with great expectations. So I hope this presentation helped. Again, I'm here to answer any questions. You guys have been absolutely awesome. And so feel free to ask me any questions you have. If I don't know the answer, I'm gonna make up an answer for you. No, I'm just playing. I'm just kidding. I'm not, but I'd absolutely try to figure out an answer for you. I'm gonna stop sharing so we can answer any questions you may have.
All right, Chris, that was amazing. I was just jotting down notes, jotting down notes. I'm gonna have a conversation with my husband tonight. He's not gonna know where it came from, and I'm not gonna say anything. But that was really, really good. I do have some questions that came from the registration form, but there were a couple in the chat. So
Okay.
I'm going to look in the chat. Taylor asked, how much should one expect to pay to work with a licensed financial planner?
So you know what? Each planner has separate fees. I would tell you this, and this is not a commercial for the credit union, but if you come to the credit union, if you're a member of Virginia Credit Union, or you go to any credit union, they will have a licensed financial planner inside their office. If you're a member of that bank or that credit union, that consultation with them is going to be free. So you can find free consultation all over the place. So you don't have to pay a fee automatically. Just look at your current bank, your current where you have your money, for credit union or bank, and talk to them initially, and they'll direct you in the right place.
Awesome. And that was a great question, Taylor. The next question that is in the chat says, does Virginia Credit Union offer financial planning services? I want to say you just answered this, but I didn't know if you wanted to add on a little bit more.
No, we absolutely do. Please come and see us, and we'll be glad to help you.
Awesome. And let's see here. We have a list of questions that came from the registration form. And some are about like stocks and investments. So Chris, I'm just gonna read them off to you. So the first one was, I have a specific retirement goal to earn $75,000 per year in dividends. How would I start that now that I am 31 years old?
So at 31, you still got a long time. So I would tell you this, you're going to talk to your advisor and they're going to set up a portfolio for you. And so when you think about earning a certain amount of money in dividends, so I would tell people this, when you go into the market, just remember this: when you go into the market, it's a market, it's risk involved in it. So when you talk to your financial advisor, you have to let them know how much risk you want to take on. The more risk you take on, you can get a higher return. But again, though, you also there's a higher risk of loss as well. So you talk to your advisor and say, hey, here's my goal, which is what I want to earn. They'll put a mix of investments together for you that can reach that number. And that's how you reach that number. But again, I always tell people, go, if you're 31, you got a couple of years, a lot of years in front of you to accumulate. Slow, steady growth, slow, steady growth. Think about, hey, you know, the old saying, the turtle won the race, right? Slow, steady growth. We're not trying to become millionaires overnight. There's nothing wrong with that, but we want to make sure we're investing in things that are going to give us a safe return that we can count on.
Awesome. That was a great question. We have another great question. How can I start on mutual funds investments?
Yep. So so a lot of people offer mutual funds. Again, I would say go to your bank right now, or you have a financial investment professional that you're using right now. Go to that person, and they can show you how to get a mutual fund. Again, there are different mutual funds out there, different returns. So again, for you, when you think about that, just talk to your professional and see what your tolerance level is, how much money you have to invest, what you're looking for in return, and they'll get you a good mutual fund. But there are a lot of funds out there.
Awesome. I will say, while you were presenting, Chris, I was thinking, like, how did I get acclimated to investing and retirement? And literally, I think it took me about 3 years to wrap my head around what a Roth IRA was, and like the difference between a Roth IRA and a traditional IRA. How do I start it? Because at the time, my employer didn't offer any type of benefits. But I was like,
Right.
all my friends have retirement accounts and 401ks, and I don't have those things. What is the 401k? So I did like research for like a couple of years before I literally was like, Tiara, you have to get started. So it's definitely a lot of information, but it is attainable. And it's good to know that there are financial institutions out there that will help you one-on-one. And you can ask them so many questions, and they're not going to say, all right, you need to pay attention. It's going to say, they're going to, encourage you to ask questions, and they're going to educate you and give you all the knowledge, because if it's something, that you were not taught growing up, you're not going to know it at all. So.
No, you're absolutely right. And I would tell you this, when you think about the different vehicles that you can use for retirement, I would tell you this, guys, everyone on this call, your bank, your credit union, your financial institution, they want you to come in. So when you come in, you start talking about your future and retirement and just, financial planning, that person is happy to sit across from you and have a conversation with you, because they want you to do that financial planning with them. So not only they want to do the financial planning with your retirement, but they want to do your home loan, car loan. So for them, it's building that relationship. So that's for any financial institution. They have a vested interest in you being successful, because if you're successful, that means hey, you know what, you're living your life, you're enjoying your life. And so a lot of times, if they're the one that's giving you that advice, guess what you're going to do? You're going to go back and use their service and products. So go to your current institution, whether it's the Virginia Credit Union or wherever you're banking, and have that conversation with that professional. Trust me, they're going to be happy to see you. And if not, come and see me. I'll be happy to see you. No.
Go see Chris.
Hey, come and see Chris. I'll help you.
Yes. All right. Our next question was money markets versus CD.
Yep. So money market versus CD, both of them are just money you can put savings vehicles. The only difference is most money markets are variable rate, so the rate can go up and down. Most CDs are fixed rate instruments. So once you put it in, that money market, that CD rate is fixed, and you're gonna get that throughout the term. So if you got a CD, say you got a CD right now, say you got a CD rate, say let's say it was 5%, right? And you got it today on April 26th, and you got it for a 5-year rate. And then in the next 2 years, the rates start dropping, that CD still be paying that 5%. If you got a money market at the same time and the rates start dropping, well, that money market's gonna go down based on prime rate. So that's the basic difference between the CD and money market. Money markets are variable rate. CDs are usually fixed rate instruments.
Awesome. And then I have a question about money markets myself. So do you have to have a certain amount? Like, I think I had a CD with credit union at one point, and then I cashed it out. And then I had a large savings account, and they had said, hey, do you want to make this into a money market because of whatever income? Like,
yeah.
Was there like a specific income for money market too?
Well, not income, but balance amount. So like, for
Okay.
example,
That's
so
what I
money
meant.
market, you usually have like a minimum balance. So money market might come with a minimum balance of $2,000 or $2,500 or whatever, but there's a minimum amount minimum balance amount for a money market. You're absolutely right.
Got it. Okay, awesome. The next question, is crypto worth investing in?
You know what? So here's a disclaimer. I'm not a fan of crypto. That's just me personally. So you have to do your research and find out exactly what crypto is. Because a lot of people think, oh man, crypto is the next best thing. Do your research and find out exactly what crypto is, what's backing this currency. And then when you come back and look me up and we'll have a conversation. So I'm not going to bash crypto. I'm just saying, do your research. Do your research. Okay.
Great answer. So our next question, I would love retirement advice as a freelancer who doesn't have an automatic retirement plan. I'd also love investment advice.
Absolutely. So for that person, again, you know what, and I'm hoping I'm not sounding like a broken record, but go to your current financial institution and have that conversation with them because they'll help you. Because a lot of times you can go online and get information, but if you're banking with someone right now, go and talk to that institution and they can direct you in the right way. Especially if you're a freelancer, that absolutely you want to go to somebody you can trust, especially if it's an institution you've been with for a little while or your family has experience with this institution. Go talk to that branch manager or that financial professional in that office, and they'll be able to help you.
Awesome.
If not, come to Virginia Credit Union. We'll help you.
Go see Chris.
That's right. Come to the credit union. We'll absolutely help you.
Yeah, and I think that's what I had to do years back. I went and they gave me a bunch of brochures. They scheduled like a one-on-one meeting with me.
Yeah,
I had
absolutely.
to read the stuff like 4 to 5 times to get it ingrained in my head. And I think with something like investing or retirement, if it's like I mentioned, if it's something that's not taught in your home or you're not taught in school, sometimes it's hard to kind of figure out what is that need and what does that look like for you at your age now. So the credit union is very helpful when it comes to that. The next question is how to obtain passive income other than investing in stocks.
You know what? So I always think of from standpoint like, say for example, my son, we were talking about one time, like going buying a lot of he was thinking about car wash businesses and things like that. And I was like, okay, the initial overhead, once you pay for the initial overhead, if you have a car wash business sitting somewhere and you have the building and they automatically do a drive through in a car wash, that's passive income, right? So when we think of passive income, think about how can I earn money with the least amount of effort that I'm putting out, that's just accumulating every month or weekly that's coming in. So there are totally different ideas how we can do that. But again, for me, it's like, your generation, this generation is so much smarter than the past generations. So you figure out what can I do that can generate money for me and with the least amount of output from me, like a physical or me having to be there for the output. So again, there are different ideas, but I would tell you this. We think about passive investing ideas with stocks. Again, when you put money in stocks, it's always a risk. It's always a risk of you losing your investment. And so that's for me. I always tell people, the money we invest in stocks, when we say passive income or putting money away in stocks, the money we invest in stocks, it should be money that we can afford to lose. It's not money that we need for our everyday life and that we need to survive. It's our money that we can afford to. If we lost this, okay. So that's where we have to take a look at that.
Awesome. That was a great answer. And it had me thinking about how we have like the internet, and the internet wasn't as popular as it is back then as it is now. We have so many resources and you can just make money from your phone and just sitting at home all day if you want to. So it's so many different ways. And I think it's important, like you said, to just be creative with that, because we have so many tools and resources now that were not available years ago.
And I'll tell you, for my generation, so when we think about passive income, for my generation is always invest in real estate. Hey man, buy you a property that you can buy, you can rent out. It's not your primary resident. You can rent it out. You can flip it. That's always my generation. It's real estate. Hey, you know what? Get your piece of land, get your house. That's passive income. Like, rent that thing out, and that's income that's coming in every month. So my generation, that was always thing. Get a piece of real estate. Now, for this generation, there's so many other opportunities out there. Whether it's buying vending machines or whatever. Creating an app that can get some passive income from you. Those are things you have to think about. What are the things now that I can do and create passive income for them.
Awesome. Yes. The next question that I have is a two-part question. It says how to invest in stock for beginners. That's
Yeah.
the first part. And then the second part, best insurance policies for building cash value.
Again, so you know what? So I'm gonna defer both of these questions because I want you to do so. You need, so for the insurance, I need you to go and talk to an insurance professional. And then for the investment, again, for beginners, I will always say, again, you can go online. There are things like called Robinhood, all different things you can go, different apps, right? But instead of going to those apps, I always tell people, I'm a people person. So I want people to go and talk to an investor in their current financial institution. And I know I've said this over and over for the last few minutes, but it's so important to establish that relationship and talk to that person and tell them, what are your goals? What are you trying to achieve? What you can tolerate? Because you can do that online, but you know what? You're really not talking to a person that's going to take a vested interest in seeing you be successful with your investments, right? So again, talk to that person. They're not going to charge you some exorbitant amount. They're not going to try to get you to invest money that you don't have. They're going to try to help you so you can achieve your financial goals. But they can help you understand what those goals are and make them clear for you and show you a path to how you can reach them. So please go, if you have a relationship with a banker right now, go and talk to that banker. If you don't, and if you're in the Richmond area, please come to the credit union. We'll help you.
Go see Chris. We need to create a commercial for you.
Right. That's right.
All right.
Yeah.
So we have one last question. I'm looking at time as well. Which is better for freelancers, SEP IRA or a solo 401k?
You know what? Depending on the rate that it's turned, I mean, both of them are good. Both of them are good investment vehicles. Man, the SEP IRA is good. You can't go wrong with either one of them. If you can do the SEP, try to do the SEP. But again, though, compare the pros and cons of both. See what the returns are, where the cost is, and that'll help you determine. But both of them kind of have like the same tax benefits that are associated with them, so you can't go wrong with either one of them. Sorry if that sounded like a cop-out answer, but I'll have to see things more. Have to talk to you one-on-one to give you a clear picture of those.
Awesome. I think that was the end of our questions. Chris, do you have contact information for everyone who is joining us today? Or would you want me to share it with you?
Yes, you can share it with them. Absolutely. Share my contact
Okay.
info. Absolutely.
Perfect. Thank you, guys. Were there any last final questions? I know it's 1 o'clock. We are at the end of today's webinar, and I want to be respectful of everyone's time. Were there any lasting questions? And if there were not, I will make sure that I share Chris's information with you all. If you have follow-up questions with him, if you want to meet with him one-on-one, today's presentation was amazing. I hope you all got some valuable information from him, and that you will put these goals into action and make sure that your retirement planning starts now, and you don't put this off anymore. So Chris, thank you so much. If you all enjoyed today's conversation, we encourage you to check out more events on our website. Also, we ask that you complete our short survey so that we can give feedback on today's event. Also, I want to let everyone know about VCU Link. If you're interested in connecting with alumni, or even if you're interested in sharing your knowledge to students and fellow alumni, and we encourage you to join VCU Link. There are links to the survey for today in the chat. There is a link for VCU Link in the chat. And then also, if you need a copy of this recording, you will receive it this week within 48 hours. And on behalf of VCU Office of Alumni Relations, thank you so much, Chris, for this valuable information. And thanks to you for joining us today. Have a great day. Thank you all.